Hey everybody, welcome back to the Market Interest, where we talk stocks, finance, and the markets. What a crazy couple weeks it's been with a lot of volatility, record-setting volatility. And let me tell you what, I don't think it's going to get a whole lot easier. I would assume personally for the next 6 months, things are going to be a bit more volatile. Why? Because interest rates are going up. We know this. Inflation's hot. It's here. Now, when interest rates go up, that creates a crunch on the equity risk premium. Tech stocks, growth stocks, those companies that have ridiculous multiples, you're going to see them impacted a lot more when rates go up. So I'm really expecting that there's going to be a big shift from growth into value stocks within this next year. Value stocks tend to do better in rising interest rate environments and higher interest rate environments. I think a lot of investors are thinking about, where can we find good investments that are producing cash, paying a dividend, instead of investing in a company where their multiples are through the roof. So instead, looking for undervalued stocks, companies that are producing cash or have the ability to produce cash, and using those for some higher growth opportunities. So for everybody who is really looking for as much growth opportunities as possible, to really just give a portion of their portfolio that really good pop, what I want to do is give an alternative to the typical, tech growth oriented stocks or those small cap tech stocks, trying to find some smaller cap value stocks instead. Value stocks, they should be primed right now for an interest rate increase. And so if we can find some smaller cap ones, some smaller cap value stocks, that should give us that additional premium, that additional pop in our portfolio to help alleviate some of the downside risk that we might have felt in the tech stocks coming down a bit. Let me show you a couple of the stocks that I bought within the past handful of months, especially this past week. Dive into a couple of the details where I think some of these smaller cap value stocks can be a good pop in your portfolio as well, potentially. These risks are not appropriate for everybody. Let me just say this should not be your entire portfolio by any means. This can be a sliver of your portfolio, but not your entire portfolio. Wouldn't be appropriate. So first stock is Obsidian Energy Company. All right, so we're looking at energy, oil, gas, and for a 1 year return up 735%, which is really it's incredible. It's awesome. Year to date, they've also been doing fantastic too. I think they're up about 72. Let's see, yeah, over 72%. So not something that should be expected to see this every single time. Energy has not been in favor for years. Up until last year, all of a sudden energy is now in favor. It's really on a big uptrend. If we take a look at their earnings per share, all right, it's $4.40, right? So that's over half of what their actual stock price is, of $7.43. So they're earning over 50% of what their actual stock price is. Incredible. Forward PE of 1.6. I mentioned it a bunch of times on this show before, guys. The average forward PE is about 16 to 17. This is at 1.5. 1.5. Super low multiples. Good value opportunity. The thing is, we want to make sure that this company has cash. Make sure that they have cash flow. So if we take a peek at their profitability measures, so the gross margin 60%, sector median is 41%. Good. Net income margin, that's huge. 102%, sector median 1.8%. So they're doing good. They're doing solid. They're making money here. I like to see that. Good area for them to make money. Let's see how much cash they actually have on hand. So cash and equivalents, 3.2 million, which, considering this is a smaller cap company, so it's not like they need billions of dollars on hand. Their accounts receivable, 44.6 mil. So that's good. So we know more cash is coming in the door. It's already there. They've got money in the bank. More cash is coming through the door, more than what they've experienced in the past quarters as well. So this looks promising. Long-term liabilities. So their capital, I'm assuming that's got to be. They've been holding it pretty level. So I'm assuming it's part of their capital structures to have that much debt. Yeah, and they've been pretty consistent. They jumped up a lot. So that's something that we should dive deeper into. I should dive deeper into and look at the reasons why they took on so much debt and what the interest rates are with that. If they secured it at a lower debt financing, might actually just work well for them as part of their capital structure, have some write-offs. So for a small cap value company, I feel like they still have some good opportunity here. They've got capital. They're doing a decent job turning over their inventory. They're in a sector that does well, that produces a lot of cash. Not paying a dividend yet, but their price to earnings is so low. It's so low right now. And with their earnings being over half of what their stock is, their per share, their prices, I mean, come on. Now, if you check out their website, pretty cool company. It shows where they're actually working. They're Canadian companies. So pretty cool. You can check it out. They've got a whole map showing their operations. It's pretty nice, nice website, what they have put together. So that's one of the companies. I know that they also did have an acquisition not that long ago, and that looks like it's been in their favor. So that's enhanced Obsidian's productivity, but it seems like their production growth has also been natural as well. So that's stock number one. Again, invest wisely. Not an appropriate stock for everybody, but it could be a good replacement for some of these, really aggressive, tech companies, tech growth companies in a rising interest rate environment. This could be a nice alternative to that. All right, now to move away from some of the smaller cap companies and move into more mid-size value company is Oasis Petroleums. This is a great company. If you look at their return, 1 year return up 265% over a 1 year period, not to be expected every single year in the long term. Year to date, they're doing a solid 6.5%. Now, this company actually pays a dividend, so I like that. Their yield is about 1.2. So that's solid. I mean, nothing, over the top. You can find, higher paying dividend companies out there, higher yields, but at least the company's paying a dividend, which I like. They are pumping a ton of cash. They're drilling for cash. So their production has been really good, and their performance has been really good, which is why I'm attracted to them right now. Average S&P 500 multiple is going to be between 16 and 17. This one's low at 9. I don't mind a P multiple, forward multiple of 9. That's not bad at all in my opinion. If we take a peek at their profitability, good measures here. Again, over 60% on their gross profit margin. Net income margin is 65% compared to 1.8 as the sector median. Return on common equity, that's crazy. That's awesome. That's awesome. I got to look into that. I got to look into that, see why. And cash from operations. They're pumping out cash, man. Pumping out cash. 788 million. Not too bad. Net income per employee. Look at that. 2.6 million. Oh, they better be paying their employees well, if you think about it. Oh. Let's take a peek at their financials, how much cash they have on hand. And this is more just thinking, what if something pops up? Let's say, they have to stop production or they need to invest in new equipment. How much cash do they have on hand in order to meet those needs? Think about it just like, any household. You want to have cash on hand for an emergency or an opportunity. Cash and short-term investments, they've got a lot. And that went up a lot the past 2 years. That's awesome. That's great. So they have cash on hand, guys. They have cash on hand. The other thing I'll point out is, there's a great article. There's a great article by Elephant Analytics. This guy, I read his stuff all the time. Really good, really detailed analysis, especially in the energy sector. So he's assuming that there could be a huge chunk of cash by the end of 2022. And, if you want to read more about the details, I subscribe to Elephant Analytics. Good guy, really smart, and getting into the detail. Article, he says that the company could end up with about over 700 million at the end of 2022. With a lot of assumptions built within the analysis, but it seems like a good, a really thorough. He did a thorough job, and no analysis is perfect, and nothing ever ends up exactly the way as planned, but pretty consistent, and I can believe it's viable. It's a viable analysis. Are the conservative multiples and conservative assumptions that are made. All right, and I'll give you one last company that I purchased more of this past week, which is not in the energy oil sector or anything, but definitely I feel like is undervalued. And I did a video on this before, but it's so sorry for the repeat. But Build-A-Bear, I think that they are primed, and I doubled down my position this past week when they dropped down, bought a little bit more. They dropped down a little bit. They took another little dip. I purchased even more. So I have some conviction in this company. And I'll just tell you right off the bat, I know it's not, complete data, but all my friends have kids and they're all going to Build-A-Bear. Then they're buying stuff all the time. All the time. I see them on Facebook, Instagram. Like, that's what people are doing nowadays. And it blows my mind because I didn't even know they were still a company, but holy moly, everybody's going to them now. And their multiples are just too good not to purchase. Again, let's dive into some of the details. Earnings per share, $2.33 a share when their share price is just under 18. Their forward multiple, 7.5 right now. 7.5. That's really good. Now, again, they're a small cap company. There's going to be some volatility involved with this, a little bit more of a higher beta. So you have to be ready to take some of that risk. But to be honest, I think their financials just match up everywhere everywhere they need to be. And then the Quant Rating on Seeking Alpha, Quant Rating right above head here, they are ranked number 1 out of the specialty stores. All right, ranked number 1 out of 473. All right, and then ranked 14 out of 4206. All right, that's pretty big. That's pretty big. Or that means something to me. Do your due diligence, do your research there. But it's fantastic in my opinion. We check out their profitability. Let's dive over here. Gross profit margin 52% compared to sector median. Great. Net income margin. That's important here. 9%. Compared to the sector median and compared to their 5-year average. So they're doing something right. They're getting better. They're improving their operations. Turnover is good. Profitability is good. I'm liking this one. They've got cash on hand. They've got a lot of inventory, and they've got some great licenses that I think that they're really leveraging that to increase their cash flow. So good prospect here. So again, the recap of this video is more about how can you transition from just growth-oriented stocks or tech stocks and move into some other areas of the market, more value-oriented. We know interest rates are going up. Inflation's here. Rates have to go up. We've got to get that under control. So assuming rates are going to go up, we know that value-oriented stocks do better in inflation-oriented cycles or when interest rates are higher. So if that's the case, how can we shift some of our portfolios from high growth tech stocks to something else where they're profitable, they're making money, they're paying a dividend, that undervalued companies that have not been super attractive for a while. We all know that energy has been like out of favor for quite a while now. Even, a lot of value companies have, but especially energy. Up until last year they did fantastic. It was a great sector. It was one of the best ones. So that, and usually those cycles don't last for just 1 year. Right? They're usually longer running cycles. We know that growth has outperformed value for, over 10 years. I want to say it's closer to 15 years. So it's hard for people to break that habit of investing in growth stocks because they've had it so easy. They've been making so much money off them for so long. But you have to understand that it's because of the environment that we were in. You know, we were in a super low interest rate environment for a really, really long time. It was easy money. Of course, we'd want to, you know, invest in some growth-oriented stocks. But when interest rates rise, that has a negative impact. That's going to crush our equity risk premium, and it's going to have an impact on these growth stocks. So where can we go instead to try and get that extra little pop out of our portfolios? I think going to smaller cap, value-oriented stocks is the way to go. That's where I'm looking to shift a part of my portfolio, not the entire thing. There's more risk inherent with that. So I would shift a portion of my own portfolio. That's what I've been doing for the past 6 months, at least. So I think narrowing in on some of those, great area. And I think oil and real estate are going to be the two primed areas within this next year to start capturing some more of that value. All right. So if you guys have any questions, feel free to reach out on our Facebook page. Go to the Market Interest on Facebook. We can comment there. Unfortunately, we can't comment on YouTube, but jump on Facebook, join the group, join the discussion. And if you have any other stocks or thesis, anything that you want me to review, shoot it over my way and I'd be happy to check it out. All right. See you guys soon.